What I'm going to look at today is activity in the Canadian markets, M&A activity in particular, and whether or not the small to mid cap area of the market is ripe for M&A. We did see two acquisitions over the past week, or takeover bids come in on HRX on the TSX and Stelco STLC on the TSX. They have takeover bids for them that were put in the last 5 days. So let's just look at these takeover bids first. One of them comes from a company, HRX HRX on the TSX. This is a company that's been in coverage for about 5 years. The company has, on this takeover bid, made a gain of around 79% for our clients. The stock price is now $31.02, market cap around $1 billion, doesn't pay a yield, doesn't pay a dividend. What does the company do? Manufacturer of aerospace products. In fact, they're the third largest landing gear manufacturer in the world. The company serves both commercial and defense sectors. HRX also manufactures hydraulic systems, fluid filtration systems, and electronic enclosures, operating across 15 locations in North America and Europe. As we can see here, strong performance over the past year, up 106%. Now, let's look at the transaction details. That's really buoyed the return there. It's done well this year, but buoyed by the takeover bid, and that came in. Let's look at the details on that. They agreed to be acquired by Platinum Equity Advisors, a U.S.-based private equity firm, for $32.50 in cash. That's a 28% premium to the closing share price on July 10th. 47% premium to the 90-day volume weighted average, 79% gain, like we said, from Keystone's original recommendation price. Let's look at the valuations on acquisition. Currently trades for a PE of around 27 trailing, EV to EBITDA of 14 times trailing, and price to FFO of around 13 times. Forward looking is about 22.69 times 2024 expected EPS. Quickly here, our conclusion. Valuation is, this takeover bid is relatively fair in our opinion, given the debt levels of the business. The current discount to tender prices are out 4.8%, with an expected closing date on or before March 31st, 2025. Keystone rated, we shifted our rating to tender or sell. We take the 79% gain and recycle those profits into new focus buy recommendations. All right, let's look at the next Canadian stock to receive a takeover bid over the last week. That company is Stelco Holdings Inc., symbol STLC on the TSX. 65.61 is where it trades today, about a $3.6 billion market cap, has a 3% dividend yield. Stelco is one of Canada's leading steel producers, operating out of two facilities, Lake Erie Works near Nantico, Ontario, and Hamilton Works in Hamilton, Ontario. The company's rolling and finishing capabilities enable it to produce not only hot rolled coil, but also value-added steels such as coated and cold rolled steel. So let's look at the stock price chart over the past year, up around 39%. Most of that gain, in fact, more than all of that gain, actually comes from the takeover bid that it received. Let's look at those transaction details. Stelco entered in a definitive agreement to be acquired by Cleveland-Cliffs for $70 per share, consisting of $60 per share of cash, 0.454 of Cliff shares. Cliff trades on the New York Stock Exchange. We'll get to that in a second. The takeout price is an 80% premium to last Friday's closing price and a 37% premium to Stelco's pre-announced 52-week high. The agreement allows Stelco to terminate the transaction and accept a superior offer subject to a customary right to match in favor of Cliffs and a termination fee of about $100 million. Now, Cleveland-Cliffs Inc., symbol CLF on the New York Stock Exchange. They're publicly traded, largest flat-rolled steel producer in North America. Let's look at the valuations on the transaction. Based on current forecast, the implied takeout multiple is about 6.5 times EBITDA, 16 times EPS, approximately, on a forward-looking basis. Fair value, in our opinion, given the volatility in steel prices and steel markets generally. Our conclusion here The Cliffs deal will likely proceed. Stelco has received shareholder approval from large shareholders, including Fairfax, a gentleman, Alan Kestenbaum, and Lindsay Goldberg, and the executive team, who all control around 45% of the outstanding shares. Further, the transaction has received support from the United Steelworkers Union. They're workers here, and there is a chance a superior bid that is not matched by Cliffs could materialize. So holding through the bid period expires at least is advisable. So with two takeover bids out there, we are being asked if this activity will continue and if Canadian stocks are being targeted in M&A activity, and why would Canadian stocks be targeted over particularly some other stocks, or North American stocks, US stocks, European. Well, we've seen a pickup in M&A activity in the Canadian markets generally. Now, generally speaking, M&A has been depressed for several years after rates rose and capital became more expensive and harder to access. We do see Canadian companies potentially being targeted, and it may actually be a good strategy. You can see here the performance of major North American indexes over the past 5 years. The laggard here is the Toronto Stock Exchange. If we included the TSX Venture, it would have been an even bigger laggard at the bottom of that list. If we look over the last year, a similar scenario unfolds, with the TSX being the poorest performer. Generally, valuations are more attractive on the TSX, and it appears some larger US companies are taking advantage of this. We'd expect that to continue. For example, if you look at the S&P TSX, the Canadian market is trading at a PE of around 21.8. The S&P 500 PE right now is about 27.45. Now, a number of clients have reached out in our weekly chat sessions via email in the wake of the HRX premium takeover bid, and inquired as to what stocks we believe could be the next companies acquired from our buy recommendation list. Now, for decades, we have experienced great exit points from stocks that we recommend to clients and have invested in ourselves. We have seen this over the past year, like we said, in a name called, or a name like HRX. Also, H2O Innovations was acquired. We expect that trend to continue through 2024 and into 2025. One of the items that you also may have noticed on that list was the second laggard of the 5 exchanges listed there over the past 5 years was the Russell 2000, often considered a larger U.S. small cap index. The valuation gap between large and small cap stocks remains at 20-year highs in favor of small cap stocks. So we believe a number of solid small cap stocks are primed for takeover bids over the next year. Now, predicting which stocks will be acquired is a fool's game. Look for a profile. This is what we do, of good businesses with solid revenue and profitability and reasonable valuations. That will lead you to companies in your portfolio that can be acquired and provide you an exit point. We see potential M&A activity generally in specialty Canadian pharma, aerospace and defense, software, gold, and the energy segment. So there's a broad range there. You're looking at that profile within those segments. It's something we expect to continue to report on through 2024 and into 2025.
Yeah, I was just pulling up from the Institute for Mergers, Acquisitions, and Alliances. I'll just share my screen here real quick. So this is directly from their website, and it's just basically saying that, let's see if I can zoom in here a bit for you. But yeah, essentially, so in 2023, there was about, again, this is for Canada, there was about 2,648 mergers or acquisitions, where this year we're looking at about 2,478. So, I mean, they're expecting, it still to be down from 2023 in 2024. But again, it does seem like, companies are starting to get maybe a little bit more opportunistic in the market environment that we've seen over like the past, or compared to what we've seen over the past, year and a half.
And we'll see if they're wrong by year end.
Exactly.
Yeah, it's definitely picking up. And I do believe if we combine those two things, the fact that In Canadian markets, generally, you're getting a lower multiple for the markets generally. Plus,
Yeah.
small cap versus large cap, the valuation gap is at 20-year highs. Typically, to give listeners, viewers, an example of that valuation gap, larger small caps have actually over history been valued higher because of their inherent growth potential is higher typically than larger cap companies. So you've seen an inversion of that, and you have the potential to see it flip back to more historical norms over time. So that's why I think you're seeing some potential more activity, and why you could see these smaller companies, smaller Canadian companies targeted. And there's a couple mid caps that kind of got targeted over the past week. We'd expect that it can continue going forward. There's also a little bit more enthusiasm in the market if rates are coming down. You could have cheaper access to capital. It's still a more difficult environment than it was a few years ago, when money was basically free. You're getting it at such low rates. You're not going to get to those highs that we got to at that point, but is it picking up? It's certainly picking up, and I think you could see some targeted buys within the Canadian small cap arena.
Yeah, I think it extends as well to do with specific industries. Like we saw Hero DevTech being aerospace. The entire industry was so beaten down with the pandemic, and they didn't really get that same 2021, 2022 just run up as other stocks did. They were still trading quite weak. They were depressed at best, and their multiples only in their earnings as a whole really didn't recover until 2023. So we're not now seeing them really return to that pre-pandemic valuation. Yeah. And since growth is expected, now you're starting to see them trade at multiples. So you're seeing Hero DevTech. We have another aerospace tangent related company in our coverage, and it's went up similarly, I think 100% since pre-pandemic, or more than that even, and 3 times since its low, 4 times since its low valuations. And that just shows if companies are looking to acquire, they have the capital. If you're seeing interest rates go down for those industries which are still relatively low valuations compared to other companies, as they didn't get that big run up, they are appealing.
Yeah. I mean, and you've been able to check off some boxes. Potential buyers have now seen who's going to survive, who is looking. You've had a couple quarters in a number of these companies, even a year at times, where they've had great growth year over year and are projecting good growth. You see backlogs come up significantly. The company that you were just referred to, the aerospace and defense company in our coverage, still outside of HRX, has had reported record backlog, good solid earnings and cash flow, and moving into a net cash position once again. Those are the type of companies. If people ask us who we think should be taken over, it's that profile, and then you marry it with an industry that was depressed and has some tailwinds potentially at its back going forward. That's why you see a company like HRX get acquired, and why we could see a couple other companies that are in those segments. Specialty pharma was depressed for a while too, and that's why I kind of highlight that segment. And there's always, you see the price of gold where it is right now. You haven't seen a ton of increases generally in some of the gold stocks relative to where gold has gone. You could see some M&A activity if they start to pick up over time as well. All right. I think that beats that segment to death. Let's, if there's any questions on that too, and if anybody out there has any companies they think are ripe for an acquisition, why don't you send those in and we can review those and see if they match our criteria for an acquisition, and we'll take a look at those.